Welcome to REITs Investment Forum by the Edge Singapore. This webinar is sponsored by ESR-REIT.
Good morning. I'm Goola, Warden, and I'll be the moderator for today's webinar. First of all, we would like to thank all of you for joining us at this webinar on a Saturday morning. The content of this webinar is largely educational, and we will be covering how a REIT is managed, how REITs enhance their portfolios by redeveloping older properties, how property valuations are done, and the myriad of rules governing the use and ownership of industrial property. We hope you enjoy the morning. This forum is brought to you by the Edge Singapore and sponsored by ESR-REIT. Now, we would like to invite our first speaker, Mr. Adrian Chui, CEO and Executive Director of ESR-REIT's manager. Adrian will be speaking on the challenges and opportunities for industrial REITs. The stage is yours, Adrian. Take it away.
Hi, good morning, everyone. This is Adrian here. It's good to see everyone there, and well, thanks for joining us today. I'm actually going to go through the presentation for our industrial REITs today. Okay, the challenges as well as opportunities. I'll just start with the challenges in the industrial REIT sector.
Adrian, sorry, can you turn on your screen? Your camera. Okay, great, good.
All right, sorry, some technical issues.
Yes. All good.
Yeah, thank you. So I'll carry on from here. I mean, I will first run through the challenges that we see in the industrial landscape, and then subsequently I will share with you, despite the challenges, what are the kind of opportunities we're also seeing in the segment itself. As you know, the Singapore industrial sector is a very highly competitive sector. It is quite very different from the hotel or office or retail market, or even the residential market for that, in a sense that in the Singapore industrial market, the key difference that it is a very highly regulated market. It's heavily regulated by the authorities, and the purpose of the regulation is to ensure that there is the prevention of speculation in land scarce industrial land in Singapore, and to make sure that the land that is set aside for industrial usage are actually put to good use. Some of the restrictions that we see in Singapore industrial sector is, for example, the JTC anchor tenant rules itself, where you will see that there is a minimum occupation of 5 years for leases with land leases as 30 years remaining, as well, and that the tenants need to occupy the space for more than 10 years if your land leases that is on the land is more than 30 years. The anchor subtenant also have to occupy a minimum of 50% of the space during the 5 years. What this implication have is that this anchor tenant rule results in the creation of a anchor tenants market in exchange for rental concession for the REITs. So the ability as well as the impact of landlords being able to just raise rentals easily as compared to the office or retail sector is actually a little more muted in the industrial sector. And also other restrictions relates to non-sale moratorium. In an office or hotel sector, you can easily buy or sell your assets easily without regulators' approval. In the industrial sector, no. If you have land that is less than 30 years, after you acquire it, you have to hold back. You have prohibition of selling for 5 years. And if your land is more than 30 years, you actually can't sell your assets for more than 10 years as well. Now, the imposition of this moratorium period means that REITs will be required to hold on to these properties longer. While this is so-called an inflexibility for the REITs in terms of how they manage their capital, but nevertheless, it also helps to prevent speculation of the sale and purchase of assets. Now, obviously, one of the key area of distinction of the Singapore industrial sector, that the land leases of industrial assets are actually very short. As I mentioned, you will see that land leases in Singapore are actually 30 to 60 years. Increasingly, it has been 30, and in recent years, it has gone down to even 20 years land lease for any government land sales. Now, this has an impact on the valuation of the properties, especially when the land leases falls below 20 years, resulting in what we call a valuation decay. So this will have an impact on institutional investors. It becomes less attractive, or that you have to compensate for a so-called a premium, and end up REITs are trading slightly higher at a higher yield than our office or hotel counterparts. Now, obviously, there's also the URA rules regards to 60-40, whereby at least 60% of the space has to be allocated for industrial use. And this restricts the type of tenants that are permissible to operate in industrial properties. And in our case, generally, because of the restrictions and usage of space, whenever the landlords wants to admit a tenant into our properties, we actually have to seek JTC's approval to such that it's an approved tenant. It's not like, unlike offices, where you can actually just have anybody who with different various of operations locate themselves in office building. So these are some of the key restrictions. Now, obviously, the pandemic, it's also good to actually address what has the pandemic past 12 to 18 months. The pandemic has an impact on the industrial sector. Obviously, the pandemic has actually affected business operations and more importantly, disrupted international supply chains, but it also presents ample opportunities for us. As you would be aware, over the last 12 to 18 months, the industrial property market has seemed to be more resilient compared to other real estate segments, primarily because there are less, I would say, in a certain way, there are less SMEs in the industrial sector as compared to the so-called retail sector. Obviously, despite the circuit breaker measures and the lockdown measures, most of the industrial production activity still continues. So that's why you will see that the industrial sector is less affected over the last 12 to 18 months than the hotel or even in the office sector. The prolonged border closures, as well as the ongoing US and China trade tensions, has severely disrupted the global supply chains. MNCs are now looking to actually diversify their global supply chain because of geopolitical risks with the ongoing US-China trade tensions, and we do not think that and I think the market and also ourselves do not think that this trade tension will go away any sooner. So MNCs will still have to look at their global supply chains and replan as well. And in fact, the pandemic has actually pushed them to even execute their plans for the global global supply chains itself. And obviously, Singapore is moving towards the high-end manufacturing. Manufacturing sector will continue to be increasingly an important part of our economy, but we are shifting more towards the higher end of manufacturing, pharmaceutical products, precision engineering sector, advanced manufacturing sector, and these were expected to have good demand for high specification properties, as more companies actually requires better infrastructure to support their high-tech business activities. Now it comes back to the REITs, how the REITs can actually position ourselves in that. We are of the opinion that size does matters for REITs. Smaller REITs actually usually loses competitive advantage across financing, economies of scale, as well as investor interest. A REIT does not retain any cash. They pay out all their cash flows. So access to capital and the cost of capital is very important to their operations as well as their growth. If you're a smaller REIT, you tend to not have the clout and not have the purchasing power or the bargaining power when it comes to negotiation with banks, and then your source of capital, access to capital, and will be much more limited. And even if you have that, it will come at a higher cost. And also, that's part of the financing. And in terms of operations, a smaller REIT does not have the ability to enjoy economies of scale to consolidate their property managers, property service management services, or when you engage third parties, facilities managers, you may not be able to have a much more bargaining power. And it also comes back to investor interest. You know, when you're a smaller REIT, you tend to be have a smaller liquidity, and in a industrial REIT sector where there are 9 industrial REITs and you're competing for the same dollar, investors tend to want to invest in larger and more liquid REITs, and this has an impact on your access to capital as well as the cost of capital. So despite all these challenges, do we see any opportunities? Yes, we do. There is a paradigm shift, as I mentioned earlier, in terms of the global supply chain. You know, your US-China trade tensions has seriously made the MNCs rethink about their global supply chain planning. Now, COVID-19 was actually the vaccine, in fact, for them to urge them and push them into execution mode. Example for manufacturing, it used to be manufacturing companies used to adopt JIT, or just-in-time manufacturing. Today, they're all talking about just in case. You better hold some goods, you better hold some of the raw materials just in case there's disruption in border closures and all. And more importantly, government actions and behaviors in this pandemic, the last 12 to 18 months, influences the MNC's global supply chain decision of where to locate their manufacturing bases as well as their activities. And I do think that the Singapore government actions over the last 12 to 18 months has instilled a confidence in some of these global MNCs that we do not just close our borders, we have plans, we do have the ability to continue our economic planning, and as far as possible, make it still a business-friendly place. So I think this borders well for us as the global economy recovers from the pandemic. As I mentioned earlier, there are shift in the industrial activities for Singapore towards more high-value manufacturing, and this is where building specifications are very important for these MNCs. If you have older and dated obsolete properties, there are actually good time for you to actually look at redevelopment to cater to these new industrialists and make yourself actually relevant. Local JTC regulations will always be there. We live in an environment where the restrictions will not go away. So the growth opportunities for industry is to expand overseas and continue to increase in size, because as you continue to scale up, you're able to enter key indices, and that increases your access to capital as well as lower your overall cost of capital. At the same time, diversifying overseas also provides opportunity to have the REIT enjoy geographical diversification in terms of location, and to address, importantly, the underlying short land leases that is key characteristics of the Singapore industrial land area. And for us, ESR-REIT, we are very lucky to have our sponsor who has operations in China, Japan, Australia, Korea, India, and all, where they have close to US 26.5 billion of assets under management across Asia Pac, and these are potential investment as well as development opportunities that we can actually tap on. And our sponsor, given the strength of our sponsor, they are also supporting us, able and has been supporting us when it comes to financing and raising of capital. I'll just go a quick snapshot of what we think is for ESR-REIT and what we have. We are seeing 100% Singapore focused REITs, 3.2 billion, 4 sectors: business parks, high specs, logistics, as well as general industrial building. As you see, our properties are all located around Singapore in the major industrial clusters, and it's close to transportation hubs and key industrial zones. In terms of there are 9 REITs in Singapore right now, and if the soil builds COP process is approved, we will probably have 8 REITs in probably a few months' time, but we are amongst the top 5 industrial REITs in terms of size. Our portfolio is pretty diversified, and we have stabilizing fundamentals. More than close to 70% of our assets comprises of business parks, logistics, as well as high specs facilities. And even in terms of our logistics portfolios, close to 70% of our logistics portfolio are comprising of ramp-up modern in-demand ramp-up warehouses as opposed to cargo lift warehouses. And ramp-up warehouses are in demand right now because of the ease of flow of goods, enable the tenants to have to do their operations and ease the flow of their goods as they operate. Despite the pandemic itself, our core DPU as well as the cash flow has stabilized and has improved. And you will see even in the year of 2020 on a quarter-on-quarter basis, apart from the first quarter, the subsequent quarters, our DPU has actually gone up, and we've seen stabilizing in terms of, and because of that, we paid out the DPU that we retained in the first quarter in the 4Q of last year. So today we don't retain any more DPU. Our cash flow is stable. Rental collections is still pretty high at 97%, which is similar to pre-COVID. So our strategy is very, on the backdrop of the opportunities as well as challenges, it's pretty straightforward. We will enhance our operation stability, and we will really rejuvenate our assets. And this is to capitalize on what we see as a trend of manufacturing sector as well as advanced manufacturing sector being more playing a bigger part in our Singapore economy itself. The outlook itself for the immediate 2021 and possibly 2022 is probably a little bit more muted, primarily because of the still uncertainties regards to the effectiveness of the vaccine rollout for COVID-19 globally. There is that cautiousness in the business sentiments, and there is also an imbalance in the supply and demand of industrial stock in 2021, primarily due to the construction delays of supply of industrial space from 2020. But nevertheless, we expect the manufacturing sector to continue to drive demand for space, although the industrial leasing market will probably be expected to remain soft itself. Capital management has increasingly become an important part of managing a REIT. For us, we adopt a very flat debt expiry profile, where you see that in any particular year, no more than $400 million of debt is expiring in any particular year. This is augurs well because we have 3.3 billion assets that's on an unsecured basis. So this flattish debt expiry structure gives us a very good way of spreading out our risk, and also our interest rates are actually hedged from 70 to 75%. Amidst the low interest rate environment, we think that this is a very optimal way of managing our capital structure. And as of right now, I can also share with you that the $181 million worth of debt that you see is expiring in 2021 has already been refinanced, and we have actually announced it about a week ago itself. The key part is actually rejuvenating our portfolio to ensure that it's future ready. We have identified AEIs across our portfolio. Over the next 12 to 18 months, we will be undertaking two to three of our asset enhancements initiative. We are also developing a standalone multi-tenanted high-specs building that is very suitable for advanced manufacturing, infocom, or data center clients. And the yield on cost upon stabilization of such assets is approximately 7 to 7.5%. Our asset enhancement that we have done in the last 12 months, despite the COVID situation, are on track to complete in this month, as well as towards 3Q of 2021 itself. And we still do have about close to 60 million of capital gains that is available to distribution, which we will utilize to support any potential loss of income of assets during construction of our identified asset enhancements assets, as well as 7,000. We will continue to divest non-core assets over the next few years. This is to improve the quality of our portfolio. As we speak right now, we are in the midst of diversifying up to $50 million of assets. Obviously, we have to subject to regulatory approvals. As I mentioned earlier, buying and selling of assets of industrial properties in Singapore, you do need regulatory approval as well. In terms of portfolio growth, we always believe that size does matters, and acquisition will always be an integral part of our growth strategies. Mentioned earlier, overseas expansion provides us diversification as well as growth opportunities. And this is where our sponsor ESR comes in. They are located in 6 different countries. They have the platform, they have the network for us, and that we definitely want to leverage on this network to ensure that there's efficient management of the assets, and that the pipeline for us includes a mix of scalable income producing as well as development opportunities for us to acquire. Sponsor still remains very committed to us. We remain well supported, and as I mentioned, we can benefit quite a fair bit for the operating platform. And you can see that over the last 2 years, the sponsor has demonstrated its support whenever we want to do any acquisitions, or as well as as well as the corporate-wide actions. They are there to support us financially. That was the first thing that's important, because we need to bulk up, because size does matters. And right now we see that the support will come as we go to the second phase of growth. As we go overseas, the support will come from the sponsor in terms of asset pipeline as well as operating platform as we go overseas. I think in short, for ESR-REIT, our stabilized portfolio provides ample opportunities to pursue growth. We continuously strengthen our portfolio quality through proactive asset and lease management itself activities. Our capital structure is very prudent. We have a well staggered debt expiry profile. We have interest rates fixed close to about 90% for the 2 years. Our all-in cost has come down, and we have refinanced all our expiring debt. And obviously, the pipeline assets from our sponsor will continue, and that presents us an opportunity to grow further and into different geography, and participate in not only income producing assets that are scalable, but also participate in better returns projects of like development projects itself. And we have the REIT actually has a first look on the ESR Group's over $26 billion worth of portfolio. So with that, I end my presentation.
Thank you very much, Adrian. That was very informative. A couple of words about ESR Cayman. They released a set of very good results last night. And they've got a couple of joint ventures with GIC, just in case you're wondering who their capital partners are. And what else did they say? I think they are interested in developing data centers, and they've also got cold storage assets in Australia. So you can all go to the SGXnet and have a look. Okay, so you can post, if you have any questions for Adrian, please post them in the Q&A section so we can answer them during the panel discussion later. Now, up next is Miss Natalie Ong, Investment Analyst of Phillip Securities Research. Natalie will be talking about pivoting to high tech. All yours, Natalie.
Hi, good morning, Goola, and good morning, everyone, all the investors who are with us today. So let me just begin by sharing my screen. All right. Okay, I hope you guys can see it right now. So I'm talking about pivoting to high tech. Yeah. So I guess earlier, as Adrian has mentioned, you know, a lot of the industrial REITs are actually trying to sort of grow their incomes in the more sort of new economy assets. So what are the new economy assets? This is like a new buzzword that has been going around. So just we start off with the definition. So the new economy sectors are the high growth industries that are on the cutting edge of technology and are believed to be one of the driving forces of the economic growth and productivity. So what this means is actually, or rather some examples are, you know, the high value add technology-based businesses, the data centers, R&D, precision advanced manufacturing, information communications technology, as well as biomedical. So the REITs are increasingly trying to grow the assets that cater to these kind of tenants, or rather where these tenants actually gravitate to take up space in. So we see that the S-REITs, or rather the industrial S-REITs, are future-proofing their assets through acquisitions of data centers, urban offices, and logistic assets, as well as converting from light industrial assets to high-spec assets. So let me just readjust. Okay. And also, REITs have been undertaking some AEIs to modernize their assets and remain competitive. So in a nutshell, that's what all the REITs have been doing to sort of future-proof their portfolios, as well as be more future-ready and strengthen their stream of income. So moving on just a little bit on the URA zoning. So URA actually divides their supply into four different kind of categories. So they have your B1, B2, your business parks, as well as your warehouses, or other logistics assets. So I guess the misconception here is that when we think of B1, we think of the more high-spec assets, but actually here to debunk some of the myths, actually some of the B2 assets, even though they're supposed to be catered to heavier industrial kind of manufacturing or general industrial manufacturing, it is possible for some of the developers and the REITs to actually build high-spec assets on B2 land. Okay. So under the 60-40 rule, the URA allows 60% of the predominant use within these assets have to be in. I mean, that means the tenant needs to be in either for example, B1, manufacturing, which are in the light industries one, and then printing, publishing, food packing, or any of these three other kind of businesses. For B2, it's generally for heavier kind of, or rather dirtier in a sense, industries. The B2 tenants can actually store their chemicals, assembly lines, as well as knitting mills inside B2 assets. So while the URA zoning actually gives an indication on the type of assets or type of activity that tenants must engage in, can and must engage in, it doesn't actually define what are the clear traits that are allowed. So basically, the whole takeaway here is that a tech tenant can be located in a B2 asset as long as 60% of the space falls under the zone's predominant use. And we'll see that in some of the later case studies and examples, that some of the REITs that have undertaken these very accretive kind of AEIs and repositioning redevelopments, they're actually building on B2 land. Yeah, so we'll talk a little bit about that later on. So basically, high-spec assets. So what are high-spec assets? Usually high-spec assets, the definition of it is actually the building specifications. Yeah. So they are generally good quality, or they have the office-like feel, high floor to ceiling height, good amount of floor loading, high power capacity to allow for office and manufacturing functions, usually air-conditioned, including all the common areas, which I guess are a little bit different from your ramp-up kind of factories. So these are examples of high-spec assets. So they are generally very fancy, look a little bit like your business park kind of assets also. And I think, and just to re-emphasize, they can be built on B1 or B2 zone land. Oh, sorry, too fast. Okay, so this is just a snapshot of the supply that's coming onto the market. So Adrian touched a little bit about the supply that is coming on in 2021. This is because of the supply that the construction delays in 2020 due to COVID-19 that pushed a lot of the supply into 2021. So here's the supply for the next 3 years. And in terms of breakdown, you can see in the graph over here, most of the supply is actually coming by way of B2 type of assets, dominated by the light blue charts, parts of the graph. So in terms of commitments, especially for FY21, over at the bottom of your screen, you see that the asset types that have the highest pre-commitment are actually the high-spec assets in the business parks, whereas the warehouses are somewhere in the middle, with the light industrials actually straddling along because of the large supply and the options that tenants actually now have. So that being said, because the URA, the JTC data does not actually differentiate or break down for us the kind of the supply that is in high spec as well as the more general light industrial, the more general industries. So we know that in general, the factory space will increase by about 3.1%, but there's no breakdown between the two, in a sense. Yeah. Okay, so now we move on to some of our case studies on how some of the REITs have actually managed to undertake such accretive repositioning or redevelopment builds. Sort of most recent a relatively large redevelopment that was undertaken was by Mapletree Industrial Trust. So it was announced sometime in July 2019 with the estimated completion of second half of 2022. Okay, so this asset, maybe I should just press this in advance first. Okay, so this asset, it looks like this. This is an artist impression, so it's still under construction. So the project cost, generally, this asset was actually a flatted factory kind of assets. And then they sort of, and it was already occupied, but Mapletree decided to actually after securing interest from an anchor tenant, which is a global medical device company headquartered in Germany. They decided to actually undergo a repositioning and redevelopment of this cluster of factories. So one of these assets here, you see, actually they'll be one of the buildings will be fully leased to this global medical device company. Yeah. And in terms of yield accretion, you can see that, okay, so let's just go through some of the benefits that the REITs will reap from undergoing such a redevelopment. So first of all, of course, is the increased plot ratio from that usually when REITs do decide to take up these kind of redevelopments, they will want to hopefully unlock additional GFA. Yeah. So one of it, of course, is from the higher plot ratio utilization from 1.5 times to 2.5 times in this scenario. That means actually that the gross floor area, GFA for short, increases by about 71%. Yeah. So that is a very substantial increase in the leasable area as well. And of course, based on previous redevelopments that Mapletree has conducted, they have managed to double their rents because in general, the flatter factories actually command a lower rent, somewhere within the $1.5 to $1.8 range, versus your higher spec assets, which come with better building specifications, your air conditioning, higher floor ceiling heights. So they actually command a higher rent, which is almost double of it, depending on the location within Singapore. And so, of course, all these factors together, it accumulated in a yield on cost of about 7%. So while COVID-19 actually did result in some supply chain delay with respect to construction, so Mapletree, for this particular asset, pre-COVID, the REIT was actually expecting a 7.5% yield on cost, but due to a 14% increase in construction costs, the yield was actually compressed slightly, but still a relatively fair amount, 7%. Yeah. And so this 7% actually, if you recall, I said earlier that this asset was actually previously, it was occupied before they decided to take on this redevelopment. And Mapletree actually catered out some space, rather within their existing portfolio, where they can relocate some of these tenants or who are occupying this Kolam Ayer cluster into. So of course they gave preferential rates for the relocation, as well as some additional cash benefit. Yeah. And also lower signing rents if the tenants decide to take up new 3-year leases. So all in, the yield on cost is still 7%. So I think that the point, as I will slowly explain, that one of the prerequisites for a successful redevelopment, of course, would be the ability to sort of increase the amount of space that you can rent, be it by increase in GFA, yeah, and also, of course, commanding higher rents. And I think a very, very crucial factor determining the success of a redevelopment would be pre-commitments. So for REITs, because generally they're more stable type of assets, they hope to get some sort of pre-commitment before, instead of taking on speculative builds. So while for this Kolam Ayer asset, only one of the buildings, 24%, was pre-committed, and the remaining was actually speculative build. I guess the pre-commitment from this from the anchor tenant did give them some confidence and also to build an additional unit. And not to mention that within this particular plot of land, there's still additional space for a third building to be built, which has not been, planned for yet. So the lease term for this asset, the pre-commitment by this German medical device company is actually 10 years plus 5 plus 5. So with the option to increase by 2 terms of 5 years. And for the rest of the space, they will target, basically tenants that are more in these new economy industries, like advanced manufacturing, info, and telecommunications sectors. So now we move on to our next case study, which is the redevelopment of 1 and 1A Depot Close, which is a flatted factory cluster as well, which has been redeveloped into a built-to-suit high-tech facility for HP. So as you can see, the buildings all look very, very similar. Your glass kind of windows, floor-to-ceiling windows. And very similarly in this redevelopment that was finished in 2017, there was a significant 150% uplift in the gross floor area. So the GPR, gross plot ratio, actually increased from 1.3 times to 2.5 times. So this is a very significant uplift, and obviously results in higher rents that can be commanded from this particular asset. And once again, because it is already a pre-committed asset, the risk to the REIT is lower, and not to mention that the long lease term of 10.5 years with additional 5-year terms does provide a lot of income visibility for the REIT. So of course, another asset that Mapletree did, which was a high-spec asset, this was more of a greenfield. This wasn't really a redevelopment, but in a sense, you can see that the yield accretion that the REIT sort of demand is around the 7% to 8% range. Okay, so now another REIT which has also successfully conducted redevelopments of their asset would be AIMS APAC REIT, or AA REIT for short. So they redeveloped their asset at 3 Tuas Avenue 2, which was previously a warehouse, and they have redeveloped it into a sort of a ramp-up industrial facility, which looks a little bit like the kind of assets that you've seen previously. Okay, so this was actually completed in 2020, January of 2020, and with a yield on cost of about 8.3%. So yes, this asset is also a B2 zoned asset, or rather built on B2 zone land, similar to the previous 3 assets that we talked about. Once again, we see that there was a gross plot ratio uplift from 0.9 times to 1.4, and also a 52% increase in GFA. And of course, this asset is fully committed to another global medical device company that is a listed subsidiary of a New York Stock Exchange company. And the lease term also, you can see, is really long, 10 years plus additional extension of 20 years. So as you can see, I think there are certain criteria, so to speak, that the REITs look for whenever they decide to undertake these kind of redevelopments. So of course, these considerations are demand, whether or not there is sufficient demand in the market. Hopefully, or rather ideally, they would like a percentage of pre-commitment for the asset. Opportunity, the ability to increase the gross plot ratio, ability to increase rents, as well as, of course, if let's say the asset was not performing very well, or recently a substantial tenant has decided not to renew, then there's an opportunity for them to actually reposition this asset or redevelop this asset. Additionally, the land lease has to be long enough to justify the building on the land, or otherwise, if they will need to see if they will be able to extend the land lease. It must be accretive to unit holders, and ideally, minimal DPU impact from the asset being taken offline. So I think in conclusion, we do see that the S-REITs have been future-proofing their portfolios, specifically with acquisitions from overseas assets with longer lease tenure. So this is also apart from getting the geographical diversification, they also allow the REITs to increase the length, or rather the land lease tenure, because in Singapore most of the industrial land is actually on a leasehold basis, and as the years pass, there's actually a decay of the land lease as well as valuations. Yeah. So when by acquiring overseas, they're actually able to get assets with leases that have 99 years or 199 years lease, or even freehold. Yeah. Acquisition of assets leased to new economy tenants. So those are like data centers, suburban offices, and the logistic assets. We have seen a lot of the REITs do a lot of acquisitions in these kind of asset types, especially in Australia, UK, Australia, UK for the suburban offices as well as your logistic assets. Another way they can future-proof their portfolio would be converting some of their assets into high-spec assets. And also, of course, AEIs to refresh and modernize their asset to remain competitive. So just to wrap things up, these are some of our calls, and of course within the industrial sector we only cover Ascendas and Capital DC, and if you've been following the REITs, you know that over the last few months actually from February to March, there has been a large sell down on some of the industrial REITs, especially your large cap names, and that has actually resulted in a very accretive sort of good entry point to average in on the REITs. Like for example, our call on Ascendas, we're actually projecting a total return of about 26% almost. Yeah. So in terms of recovery, just to touch on this for a bit, we see that while in 2020, of course, the sectors that were most affected were the hospitality and the retail, understandably. And then we have your offices as well in the red, but your industrials were still positive. I think this was largely driven by the acquisitions that were from 2019, which was sort of like a bull run for the REITs. And then so coming on into 2021, we can expect that the industrial REITs to actually DPU to grow by about 7 to 9% here, and this is, although this is less compared to your hospitality and your retail, which will see DPUs recovering by about 30 to 40%, we must understand that this is actually on the back of strong performance or rather resilient performance from the industrial REITs in 2020 versus a lower base for the rest of the hospitality and retail REITs in 2020. Yeah. So that pretty much brings me to the end of this presentation. So I'll hand the time back to Goola.
Thanks. Thank you very much, Natalie. That was very good. That was very interesting. Yeah. So do post your questions for Natalie in the Q&A section so we can answer them during the panel discussion later. We do actually have a lot of questions on this land lease running down. So the panel will be prepared to answer those questions, right? So now we will be going for a 5-minute break before I invite the next speaker on stage. So see you back in a bit.
ESR-REIT, with a diversified portfolio of 57 properties located around Singapore, we are future ready to meet the needs of our tenants, our unit holders, our investors. We are your trusted partner for your business tomorrow, today.
Hello, everyone. Welcome back to the REITs Investment Forum. Now let us welcome Mr. KengChiam, Executive Director and Head of Colliers International. KengChiam will be speaking on valuation of industrial properties, and I think he'll have a lot of questions to answer at the end of it if he hasn't answered it already in his presentation. So it's all yours, KengChiam. And do remember to share your slides and presentation mode. Hi, KengChiam, can you put this on presentation mode, please?
Okay, let me try that.
Is that all right?
Give me a minute.
Yeah, sure.
Is it on presentation mode now?
No, I think you had pressed it correctly earlier. Hang on. Wait. Yes. Can you see the arrow? Can
Is
you?
it on presentation mode now?
Yes, great. Okay, go ahead.
Okay, good morning, everybody. It's a Saturday morning. I'm delighted to be here today to give you a glimpse of what I do for my last 30 years as a professional valuer. And what is interesting to observe is that the first two speakers have been actually giving you a very good background of those issues and information that we require to interpret as a valuer in order for us to do our work. And you can see that there is a lot of information, be it planning, legal, and actual execution of ground that we actually have to be able to decipher in order to give you our professional and independent view. So for Adrian, I think he is the property owner, looking at the sales, doing all the deals, and then I think we are the ones behind to interpret all the actions that is taken, the decision making, and then focusing on just the real estate value. So I think I have emphasized that we are actually doing asset valuation and not business valuation. So every property is looked at individually. And then we have Natalie, who actually is an analyst looking at all the actions of the owners and then interpreting them from an analyst perspective. And I'm the one who will be the one determining the values for their books keeping purposes. So without further ado, I think I would like firstly to introduce my company. We are actually Colliers International, a global company that has offices all over the world in 67 countries with 18,000 employees. And we generate about 3.3 billion of annual revenue. So I think we are well represented in especially the 3 continents, US, Europe, and as well as Asia. And a bit about myself, I've been in practice for the last 30 years as a professional valuer, overseeing some of these big deals that takes place from time to time. And then insofar as the assets value that I have valued in total will be in excess of 100 billion in my entire 30 years of experience. And I specialize in dispute resolution work and I have acted in as expert witness in court in many of these landmark cases. Okay, and I am heading the valuation advisory and consulting service in Colliers, doing mainly property valuation and consulting. So in the property valuation that we do, we represent clients in litigious cases, financial reporting for bookkeeping, rental disputes, and then property taxation. And also the other part of it is there are a lot of decoupling going on, and we are also the valuer to ascertain the value for people who want to decouple the assets. And increasingly so, the tax portion here is becoming very important because of the need to pay for the ABSD of residential properties. So I think we are also here to be able to separate the commercial for shop houses, the commercial value, and the residential component, which is actually required for tax purposes. And in consulting business, we determine the highest and best use of properties for owners to decide what they want to do with their properties to enhance the value of the property through all these studies. Then we do market studies. For instance, like, the general market studies, specific targeted studies on shop houses, which is not easily available. And so far as town planning is concerned, we do also have planners who are actually able to conduct studies for places in other countries. And insofar as Singapore concerned, I think we are a very well-planned city, and our planners are doing a very, very good job. And the only thing that we can do are, some of these targeted, specific town planning or in small areas. And the other bit that we do will be feasibility studies as well. So in today's agenda, I will be covering a little bit, give you an overview of the industry REIT market in Singapore, a brief snapshot, and then the valuation, how we do valuation of industrial properties for the REITs, and I'll conclude. As you know, I think there are altogether about 33 REITs in Singapore, of which 8 are industrial REITs, with 1 specialized DC center REIT, making up 33% of the total REIT market cap of about 96 billion and still growing. And as you can see, this is the second largest segment in the REIT market, the biggest being the diversified REIT, which comprises mainly commercial properties. As you can see from the chart, the 10-year average price to book ratio of the REIT are actually about 1 time. And at the moment, the industrial REITs are trading at about 1.2 times of price to book ratio. And the other 2 that are in the spotlight are logistic REITs, which are trading at a higher premium of 1.4 times of price to book ratio, and data centers trading at a very high price to book ratio of 2.3 times. And there's specific reason for that, because there's a moratorium on the data centers that we can build, because I think they take up a lot of resources, and people are very bullish about this sector of the market. And insofar as valuation of industrial properties, I think what we need to be aware of is that it is not an easy segment to value, because I think as the previous presenters like Adrian and Natalie, they have actually gone into details to express and inform you about the various types of regulation types, characteristics of the properties. And I think we actually need to, as a professional valuer, I think we need to actually understand each and every asset, how they are, what are the characteristics and features when the deal is done. And I'll explain to you later in details. So firstly, I think there's a different classification of properties. Generally, you can look at it from a landed properties or strata titles. So as you know, the landeds are standalone or even terrace factories or semi-detached factories, no different from our landed residential properties. And so far, strata titles, they are usually small units that is similar to that of the apartments that most of us are familiar with. So they are actually stratum, airspace, unit by unit, and usually they are small. And then the other classification that we can do is single user, multiple user factories. And in Singapore, the main regulator for industrial properties is JDC. In fact, JDC is now the main body that is monitoring or regulating the industrial property market. And the different classification, I think the previous speakers have also expressed to you. So they are mainly logistic warehouse, high-tech factories, data centers, store hub. And then there's increasingly a component of commercial properties to support the occupants within all this factory space. And especially so if you see Paya Lebar, there's a certain cluster of the industrial land that are accorded 30% of their land or as additional plot ratio of 1 as commercial purpose for commercial use. So this is actually to support the users within the industrial estate to bring life and balance the work-life environment within the estate. And the key features that I would like to highlight, I think increasingly people are aware of the pitfall of leasehold properties, but I think there are solutions to that. So I think generally we have leases of up to 99 years, especially for industrial properties, most of which will be, in the past, it used to be 30 plus 30 or 60 years. And increasingly, I think we are seeing shorter and shorter leases of 20 years or lesser. I think the idea behind it is that, and then the restriction that was put on the owners is more around the fact that the businesses actually will grow over time. So as far as business is concerned, 30 years is sufficient for them to grow to a certain size before they go on to a bigger premises. So that's the reason why leases are now at 20 to 30 years to start with, and not anything longer than that. Of course, there are options where there are leases that are longer than that, 40 to 50 years or even 60 years. But however, that is increasingly getting lesser and lesser. I think that is part of the strategy to prevent any speculation on industrial properties, which actually is a very backbone of our economy, supporting the employment in businesses. And the other features that is very challenging, which I think when one interpret the transaction, I think one has to be very clear about whether the property, especially the JTC ones, whether they are on land rent, land premium paid upfront, or even cases upfront, part of it where upfront premium is paid for first term, and then with the remaining term on annual land rent, or this land rent could be replaced with an upfront premium upon the expiry of the first term. So increasingly, I think it is difficult to get such information because I think unless you look at the leases, if not, they are not very obvious to the common eye. And then the other aspect of it is restriction. And Adrian has actually gone into detail about the anchor tenant requirement, the 60-40 ratio, and a lot of others restriction. In fact, if you want to extend your lease with JDC, if JDC has got the refractory interest, they are actually able to consider extension. And that provided you have a business plan to be able to support the extension. So these are the considerations that is important, especially so for those leases that are less than 10 years. So there's in fact, you can categorize the type of industrial properties into those that are being sold under the government land sales program, and they are considered as private land, vis-a-vis JTC land, which actually has got more restrictions. So under the GLS side, there are lesser restrictions compared to those JTC sites where they actually do direct alienation, and they do direct alienation in support of your business that they are promoting. And insofar as government land sales is concerned, there are some restrictions, but not as much as the JTC properties that are being sold to business these entities who occupies them. So JDC properties are actually subject to all the leasing rules and regulations. And so far as development is concerned, there are two layers to it. First of all, I think if it's on JDC land, JDC will actually be the first port of call to actually review your plans, and then to allow you to go for further submission to URA, who will look at it from a broader perspective. So for those properties that are sold under URA land sales program, the restrictions are lesser. Then for the change of use is much easier than if it had been for JTC. And that itself will actually affect the land prices or the property prices. And let's talk about something that I do day to day, valuation methods. All right, so essentially there are actually about 4 methods. And let me go through them. First method, direct comparison. And this is a method that uses the principle of substitution. Well, valuation is actually very simple in terms of the math, but I think it involves a lot of concepts, understanding and interpreting all the information or all the interest that is attached to the real estate, be it physical aspect of it, the location, the size, the tenure, the restrictions, the tenancies, and also the market condition. And the direct comparison is best used when there are high volume of homogeneous properties, where the adjustment is made, the more accurate it is. So, for instance, I think we all know that locations. We actually have to understand a property between a property in Jurong and a property in mature estates like Kallang Basin, Kallang Baru. It does have differences, and the difference is mainly due to the land. The building may be the same, but the land value is different. So I think these are the adjustment that we make to reflect the differences. For instance, the building can be the same, but the location is different. And when you're at different location, the pricing comes of the land, comes into play. In terms of layout and design, for instance, I think what you have seen in the past, especially for data centers, warehouses, when the demand is low, it can be converted to a higher use, which is the data centers. And you can see that in the cluster at Tai Seng Drive, where it has become a cluster of data centers, which actually has got the ready infrastructure to support the data center operations. So the lower use, which is the logistic warehouse, is being converted to a data centers, and that itself gave a premium almost immediately. And in terms of tenure, I think this is a very important topic, and it's something that people would like to know, especially leases. And given that the leases will be decaying year on year, what I would advise everybody when you buy a property, of course, the longer the leases, the better it is. If you have 30 years lease, you actually have, if you think that profit cycles from peak to trough is actually, or one cycle of property is 10 years. If you have a property that has got 30 years lease, you actually have got 3 cycles, meaning to say that you can get out along the way. You have at least 3 rounds to monetize your asset at the peak. As the lease gets shorter and shorter, anything that's less than 10 years, I think then you will have to be prepared that with every passing year, there will be decay, because the number of years that you can receive rental will continuously diminish over the 10 years period. And there is difficult, in fact, it's very difficult for you to actually be able to get a capital appreciation. I think from the historical standpoint, when the market dips, that was in the past, it went below building costs. And that is the best time when you actually can confidently purchase the property, right? So, and there are questions as to what happens when the lease runs out. So like I mentioned earlier on, if this were to be on JTC or even private land on leases, should the reversionary owner, if they have enough of the tenure, you are able to extend. But if not, you will have to, at the end of the lease, surrender the property, just like Lorong 3 Geylang, which was being taken back by the government with I would say very little compensation or no compensation at all. Yeah. The other part of restriction, all right? So insofar as restriction is concerned, we have to interpret, and increasingly very challenging, whereby the approvals are given on short term. So what happens is that, what we see quite common is that those food court, warehouses or factories on the ground floor converting to canteens or food court. And that actually attracts temporary development levy if it's given on short lease term, because food court are actually commercial use. However, there's also another variant, the food court. There's also a classification of food court that actually are zoned industrial, provided you only serve the occupants within the building, and that you do not have to pay differential premium or development charge. So all these restrictions are very unique, and we have to be careful such that we are able to capture the cost that has to be incurred. I myself, I was involved in a very litigious case whereby a showroom, when used by a third party, is considered commercial and differential premium had to be paid. So one has to be very careful about the treatment, whether that use, although it may be the same, but it can be interpreted as commercial use and therefore DC is payable. So do not sign tenancies when you're not sure about whether that industrial space is actually for commercial use or qualify as commercial or industrial use, because that has got financial implication. And so far as tenancy is concerned, so we will have cases of long leases. If you have long leases, it can be good and bad, depending on the level of rents that's being signed. So, and then the stability of the tenancies. So increasingly, I think we have to actually be mindful about the security of tenure in the form of whether the occupants are actually good tenants, credible tenants that's able to pay the rent. Otherwise, the rents will fall, especially when the rents are higher than the market, where this overletting will be captured in the values. And so far as the physical condition is concerned, I think a building that is well maintained, old but well maintained, and a building that is old and not maintained does makes a difference, because the rental that you can collect is different. And there are also cases whereby looking at the efficiency of the properties. And insofar as market condition, I think we have, because I think we use the comparables when it was transacted is very important as well. So as valuation is always forward looking, we will look at the past to help us to determine the value in the future. So I think if the market has improved or not, we have then to make the necessary adjustments. And the second method and this is the method that is used very much for REIT properties, because they're all income generating properties. And it's on the principle of profitability. So all this income, investment grade properties, buyers like the REITs will have to be looking at whether the asset is yield accretive. So I think the cash flow is very important. The difference between the direct capitalization method and the discount cash flow method is basically, one is a static model, looking at it at one point in time, whereas the discounted cash flow, we have to then project the cash flow for be it 3 years, 5 years, 10 years. But normally the assumption made is that, investor will hold the property at 10 years and dispose it at the 10 years. So this is the assumption that we make in order for us to ascribe a property value using the discounted cash flow. So the components are no different. It's just the treatment that is different. For instance, direct capitalization method, what we do is we will then determine the market rent. We will deduct the operating expenses, whereby we derive the net property income and a capitalization rate applied, which can be interpreted inversely as the multiples of the income. So that will actually be the one to determine the market value. For leasehold property, I think one has to be careful not to just look at the cap rate as a direct division, because the tenure of the lease, long or short, I think it can be calibrated based on the same yield using the summation formula. So for instance, like a cap rate of, let's say, a 10-year at 6.5 will have a certain multiples. The same cap rate for 20 years will have another multiples. And the inverse of that will give you a different yield. So that, I think one has to be careful understanding how it's being derived and determined. And what we observe is that, we will always look at, the performance, past performance, getting it from the owners of their cash flows. And of course, the challenging part is that when we see that there's inefficiency in terms of the way they operate, they may have spent too much or spent too little. So all this adjustment is something as compared to what the general market or other property owners are doing. So this is something that we will have to make the adjustment. Therefore, sometimes don't be shocked if you see that our net property income is different from the actual. And so far for the discounted cash flow, we will project the 10 years cash flow, capturing the growth in rental, capturing the growth inflation rate of the cost of operation, the OPEX. And then we will apply a discount rate, which is something which we can get from the market. And then insofar as the terminal value, it is using the capitalization approach to determine the terminal value with a terminal cap rate. So the 10-year cash flow will be discounted to present value. So is the terminal value. And together, collectively, we will then ascertain the capital value. So this is actually the most preferred method that we use as compared to the direct comparison method, which is actually a very simplistic methodology, which I would say is more applicable to strata title development. And the other method, which is cost approach, which is normally used for specialized properties like shipyard, where you have to look at the cost of the embankment, cost of the slipway, or even refineries where they have a lot of plant machinery. So insofar as industrial property is concerned in Singapore, I think they are very, very synonymous having rental income generation. So I think for insofar as cost approach, we will then ascertain the land value and the building value, and then we add them together to come up with the valuation using the cost method. And the last method is basically the residual land value. And this method is based on the principle of production. So basically what we do is we look at how much you can sell at the end of upon completion of the property, and then we deducting all the profits and the costs to arrive at the land value. And this can be applied to properties that are going through AEI as well, because substantial costs will be incurred to do all the A&A works to enhance the property, and then the residual value will be in its existing state, synonymous with a land value. All right, so as you can see, I think the math in doing the valuation is very simple. I think the difficulty is to be able to look at the specific characteristics of the property in order for us to accurately determine the value of the property. For instance, like the cluster of properties within the Tai Seng area, like I mentioned, they do have the first term, that is where the land rent is being paid up front, and only for the commercial component and not for the industrial component. So I think we need to be able to decipher that and understand. And there are also cases whereby the property has got JTC factories has got the land rent being paid upfront. So I think let's not mix the two together. Otherwise, the value comes up will be different. So in conclusion, I would like to say that it's very important for us to be able to understand the characteristics and the types, and it makes our work very challenging. I mean, when a transaction is done, unless we know the property well, otherwise, the details of the properties are not easily available. So I would say that everybody is saying that valuation is an art, but I would like to say that it's an art of being able to distinguish the differences between the various types and characteristics and understanding the similarities or differences in value in order to be able for us to ascertain, especially if you are using as a comparable. So with that, I would like to end my talk, and I welcome question and answers.
Thanks. Thank you. Thank you very much, KengChiam. Thanks.
Most welcome.
So let's welcome back the other panelists as well, because we've come to the last and I guess the most exciting part of our webinar, the live discussion and the Q&A session. So welcome back, Adrian and Natalie. There you are. Okay. So actually, there have been a lot of questions on valuations, but let me just jump to a couple of other things first. Can I just ask? We've had lots of questions. We've had questions during the course of the last 2 weeks, and we've had lots of questions this morning. So I just want to go back to the questions that we've had in the last 2 weeks. So what sectors or industries do you think will be needing more industrial space in the next year or so? And which REITs or developers are in the best position to supply these needs? Adrian?
Yeah, thanks. That's good to be a first one to ask. So thanks. Yeah, my opinion is that given where the economic situation now, as well as going forward, where the Singapore economy is being positioning ourselves, and definitely there is a change in the global supply chains, as well as manufacturing sector, from precision engineering to pharmaceuticals to all the high value add, will be actually the one that is driving the overall manufacturing economy. Because of that, I think the high specs as well as the warehouse segment are actually the bright spots, given the expected strong performance in the manufacturing sector and the global supply chain realignment. Now, the key is actually, as Natalie pointed out in some of her study, the key is actually to make sure that you actually have the assets that are, I know a lot of people like to use the word future-proof. My keynote of that word is not future-proof. We can never future-proof our assets. We can only be future-ready. And for industrial properties, unlike office, where the lifespan can be 20 to 30 years, for industrial properties, because of the usage of the high frequency of usage of manufacturing activities, as well as technology changing, lifespan of industrial properties tend to be about 10 years. I would say 10 to 15 years only, and that's where you got to start rejuvenating the assets. And the rejuvenation assets is also a function of the economy that is being attracted to. The sectors that's being attracted for the build-up of the economy of the country. So my take is that the high specs and warehouse segments are going to be the one that's more sustainable and more in demand going forward.
Okay, thanks. Okay, Natalie, what's your view on this?
I think it's just like Adrian said. The sectors that will be demanding for space: the biomeds, the precision engineering, and advanced manufacturing. And yes, also of course the logistic assets that are getting more interest, especially from the 3PLs, as e-commerce becomes more pervasive, I guess. Yeah.
Okay, so I need to move on a little bit, and so to the next question, and that's when KengChiam will have to answer that, and that is there are lots of questions on inflation and interest rates. So how do these affect valuation? KengChiam, could you take that one?
Okay, I think interest rate is actually one component of the real estate purchase. It does affect the expectation of the returns from all this real estate investment. So to a certain extent, there is some correlation. I would say that from historical perspective, I think there is good correlationship. I mean, I do remember that, even especially for shop houses, HDB shop houses, I think in the past, they were getting yields as high as 6 to 8%. And that's what's on our our interest rate was around 3 to 4%. So now that interest rate has come off to about 2% or less, what we are seeing is that there's really cap rate compression, and we are seeing, you know, all these HDB shop houses, especially the good ones, that's well located, doing around, you know, 2.5 to 3%. So I think interest rate and similarly for the REITs, you know, when the interest rate move, I think the expectation of the returns will also react accordingly lah. Yeah. So maybe, you know, Adrian can attest to that too.
Yeah, okay.
Adrian, sorry. So when the interest rates rise, will the cap rates expand, and would that affect capital values?
Yes, it does. But of course, there are other factors as well, not necessarily just interest rate. So this is one of the factors that will affect, you know, how we look at cap rates, because I think it's one of the components. Of course, I think what we normally see will be 10-year bond rate, whether the movement is also affected by the interest rate. So I think that itself is already priced in. Yeah.
Okay, thanks. Adrian, okay, can you take this question on how do interest rates generally impact the REITs? Because it's not just the valuation, right? There are other things that are affected by interest rates.
From a practitioner's basically point of view, this is and the cost of capital perspective, this is actually a very key important point of view that we always consider. We're not brushing it aside, but we need to always go back to the fundamental. I mean, you ask any professor, university professors, they will tell you that it's inversely correlated. I mean, we all know that. You don't need the professors to tell you. Your books off the shelf could tell you that. But what we basically as practitioners is we see real estate as a long-term game. There will be always be property cycles, interest rate cycles. But the key for us as practitioners is that this is a long-term game. What is your strategy and what is your actions that you are doing for these assets? If you plot a chart at a spot in a 10-year chart, you will generally see that the DPUs as well as the capital values of properties in Singapore and in REITs generally rises over time. You look at total returns, you look at yield, and you look at capital values. So if you plot a chart of 10 years, 20 years, that's what you're going to see. But if you decide to plot that chart in a narrow 2-year view and it's in a high inflation rate, I think everything goes goes down. So I from my practitioner's point of view, the key is always that yes, we take into consideration interest rate cycles. We have to do that because it affects cap rates and valuation. But more immediately for us is that what does the interest rates and yields, rising interest rate has an impact on our debt cost, because that's an impact on your P&L and that goes into DPU. And this is where capital management actually comes in. To answer the question on the impact on valuation and capital values, you have to look at the long term and where you start to do your rejuvenation of assets to make it future ready, to make sure that you understand where the trend of the users are going. And this is the one that is the best protection for long-term valuation that you see. But in the short term, capital management increasing very important for REITs, because if you end up unhedging your portfolio, you can end up over-hedging or under-hedging. But the key is that to make sure that you have a view, you take a certain positions to make sure that you protect at least bulk of the downside risk without giving away the house.
Okay, that's good. Yes. So capital management is really more of a science than an art. Yeah. Okay. So so for Natalie, still on the question of interest rates, during inflationary times, can DPUs outgrow or outrun the rate of inflation over time?
I think generally the REITs do try to ensure that the rental growth rate will be at least on par with the inflation. I mean, even if you look at some of the leases or REITs with tenants, they have very long leases. They usually come with escalations. If they are in the Europe side, probably it will be a CPI linked. And then otherwise, it would be anywhere between 2 to 3% or 1 to 3% maybe annual escalations. Otherwise, it could be a periodic escalation, maybe every 5 years, then we will be re-rated. So in a sense, the hope is that, of course, the REITs will be able to, provide inflation protection. Yeah.
Okay, thanks. Okay, so All right, now we've got a lot of questions on this short land lease thing. I've written them all down here, but it's a bit dark in this room. Okay, so what happens? Okay, so KengChiam, you're going to be very busy now. There are lots of questions on what happens at the end of the land lease, of the land tenure, and you know, how do you value the properties as the time runs down? Yes, there's time decay. And well, could you start with that first? And then there are questions on how important are tenants? And then I'd like to add that how important are master leases? Yeah, could you start with the time decay first?
Yeah, I think the time decay, like I mentioned earlier on, when we do the assessment, I think the tenure of the lease is actually taken into consideration. So like I mentioned earlier on, that, you know, if you have a term that is 10 years, even assuming for a 10-year term and a 20 or even 30 years term, the cap rate, even if they are the same, theoretically, I mean, if let's say that hypothetically they're all the same, the multiples will be different. So in that sense, the number of number of years of earnings will be calibrated according to the term. So what I'm trying to say is that, for instance, like a 10-year lease term at a certain percentage of returns will give you, you know, less than 10, all right? So if you are more than 10, implicitly, you may be overpaying because you don't have that number of years or runway to recoup back your investment, all right? So for instance, a 10-year lease at a certain cap rate, it should be able to be less than 10. So for a 20-year lease term, it will be less than 20, cannot be more. If it's more than that, you're overpaying. So that is how it works. And insofar as what happens when the lease ends, again, like I mentioned to you, it will depend on whether, you know, you will have to understand the reversionary owner's interest. If the reversionary interest owner do have enough time on their side, they can actually do the extension. Because don't forget, JDC is an agency that actually is an agent of the government. So what they do is that they will procure land at a certain term, and then they will then carve out shorter leases to the users. So for instance, like if starting from 1960s, they have 100 over years of lease for them to manage. So they're able to give you 30 plus 30. So I think as the years goes by, it gets shorter and shorter. They can have another cycle of 30, but beyond that, they will not have any more. And they will have to then recycle the land, get another lease from the government, and then be able to do the extension. So I think what's important is that you have to look at the reversionary interest of the owners, and there's a mechanism insofar as state land is concerned. There's a mechanism insofar as not only talking about, let's say you talk about government land sales. Government land sales, it's policy driven. So as you can see, there are many en bloc sales going on, be it residential, industrial, office. So from time to time, the government or URA will, together with the agencies, look at the master planning and then craft out a policy. That's why you can see that, you know, and where there are areas that we have a big plan and they have big plans for the usage. For instance, like Lorong 3 Geylang again, they have this policy of taking them back. So far, what we see is from the observation that, you know, residential land, especially the ones that's owned by HDB, at the end of the lease, they will actually take it back. Yeah.
Okay. All right, thanks. Adrian, how do you manage the, land leases? Do you pay land rent, and what do you expect to top up any of those leases? Could you?
No, like what KengChiam said, obviously at the end of the day, whether the land leases can be extended, it's also reversionary interest. What we see in majority of our leases in Singapore is that JTC has a reversionary interest of at least another 30 years or so. But as a practitioner, we're not here to hope that, oh, come the end of the lease, JTC will be nice enough to give it to you. They are not a charity. They run a government, they run organizations to make sure that the land users, scarce land is put to best use. So as industrial practitioners, our point is make sure you want to get the land lease extension, you got to go to them and show them what are you going to do? Are you going to spend money to make sure that you spruce up this space? Are you going to have a new concept? Are you going to bring in new tenants, bring in new industries? Basically, you got to go back to them to tell them that this is my idea, and this is what the landlords like us always do. Your job, as I said, you always be first principle as a landlord for industrial bodies. You are supposed to be future ready, and that is where you have your teams outside are seeing which is the industry trends, which are the new industries that's coming in, what kind of technology that they are doing. 10 years ago, 20 years ago, nobody cares about data centers. Everybody thought it's just a room full of servers. Today, well, I mean, you can see with the valuation. So technology changes. The key is to position yourself to understand where it is, and then imply and convert into a concept and able to convince the authorities that, look, this land, scarce land, is still being used for good factors of production, and please, and I'm going to put money inside, and based on my plans and all, I would like a land lease extension. So it comes back, then go back to KengChiam's point of view, is that then you can actually value that land as a factor of production, and that the valuation will still take into consideration the extended land use. Now, I put one more point, is that while the land is 30 years, be it 30 years or 60 years, from a REIT's perspective, from a REIT investor's perspective, you are actually paying for what you get. If today all the industrial REITs have all freehold land, it would not be trading at a rate of 6 to 7% compared to an office who has freehold at 99 years, who are trading at 3 to 4%. So essentially, if your assets, you are paying for what you get. There's no free lunch here. So that's why I say that the pricing of the short land leases in Singapore, the effect of the short land leases is already priced into the REITs already. Yeah.
Yeah, that's why you get the higher yield on the
exactly.
Indeed. You get some of the capital back in your DPU, in your yield, in your yield, because that's the way that's the way it works. Okay. So can we just stay with me, Adrian? In terms of tenants, so how important are tenants? I know that there's an impact on the valuation. How important are tenants, one? And second, you know that master leases, I think we've spoken about this before. Master leases used to be very popular about 10 years ago. Then they seem to have been given, I must use the word, a bad name by some of the issues we've had in the last 5 years. So how do you view these? And are they better, or are they not so good for the REITs? What's your preference?
My preference, okay, I used to think that master leases are at the accepted norm, that master leases to give you growing and stable distributions, and it's very prevalent in overseas countries like Australia and the UK, where they sign long leases. My sense of it is that it can be a double-edged sword, and I'm increasingly leaning towards less master leases or even shorter. Why? Because technology changes, industrial changes. The good part of master leases is, I say, long growing distribution. The downside of it is that when you go into master leases, the REIT manager has become a credit analyst, because you got to make sure that you are analyzing whether the tenant who signed your 15 to 20 year lease is someone that can see through that 10 to 15 year leases. So the credit risk of the company, the master of the tenant, is very important. So you're not just looking at real estate. You're now going into analyzing the credit of your counterparty. How credit worthy is this counterparty? And now that's a different ball game altogether. Second downside is that when you have a master lease, especially in the case of sale and leasebacks, generally the owners basically sells to you and you lease back for a long term. Now, fundamentally, there is always a mindset that when this is my house, I will take care of it. When I sold it, it's not my house. I don't have the motivation to keep it spick and span. And there's a chance, probability, that after 10 to 15 years, your property becomes obsolete. If you are in a multi-tenanted building, as what we like to have, as a landlord, you are different. You need to make sure that it's well kept. You have to do asset enhancements. You got to make sure that is future ready and all. But if you are a master lease of 10 to 15 years, generally speaking, the landlord cannot go inside the building for 10 to 15 years because the tenant has to do his production. He's not going to shut down his production. He'll let you do your asset enhancements and all this stuff. So so that is what I think that we have to trade off the balance. But as a REIT manager, you need to balance both. You cannot have all 100% multi-tenanted and 100% master leases. You just have to do that. And when you do the master leases, you just got to be careful of abusers, you know. But I do think abusers of master leases, where people try to do over-rented and all this stuff. I think investors, REITs has been in Singapore for close to more than 20 years. You have learned investors like Natalie and a lot of other learned investors who actually can see through a deal whether this transaction is what we're going to call financial engineering or not. Financial engineering is not bad. I don't think that it's bad. When you use it appropriate way, it actually allows the REITs to actually acquire a quality asset that would otherwise not be able to acquire, and then you allows the REIT manager to actually then undertake whatever your execution, leasing strategies or asset enhancement and all. So my conclusion is that master leases is used correctly, it benefits the REITs, and that in view of the changing technology, especially industrial sector, I do think that the cost today outweighs the benefits of having too long a master lease.
Okay,
That's my view. This is my view.
Yes. Yeah. Thanks, Adrian. Yeah, I want to ask KengChiam. Yeah, I think Adrian alluded to this financial engineering word, which sometimes in the past, you know, there used to be a lot of income support built into some of these acquisitions. How do valuers look at income support, one, and master leases, two? Yeah.
Okay. Okay. I would look at it more like a structure, no different from how you know M&A takes place. So insofar as the lease is concerned, I think the sales and leaseback structure, I think is an arrangement that is in a contract. So there are consequences for not abiding to it. All right. So I think it then in a way ties to the property, which we then have to take into consideration when we do the valuation, be it a case of overletting, underletting. So I think the key is, of course, a few things that we have to take note. Yeah, I think I mean, whatever structure that you have in the marketplace, I mean, if it's applied correctly, I think it has its benefits. So I think we have to look at it objectively and professionally. So I think the thing about master leases, having long leases, I think if you look at those MNCs, they are investing huge amount of money into the property. So they will not want to, you know, have short leases, and they are usually want to sign long leases with you. So in that sense, owners owning the property has the comfort that these are blue chip companies that are able to pay you market rent and for long leases. So in a way, it's no different from a bond. All right. So I think if you look at it from that perspective objectively, I think it's this structuring actually helps everybody. It's a win-win situation. All right. So I think insofar as sales and leaseback is concerned, I think we then the next thing that we look at is whether, you know, the rentals are actually in market or not. So very often you hear that the professionals will say that, look, you know, whether is it company A or B, if the rent is done at market, if it's today is 150, they do it at 150, it doesn't matter, because the only thing that you will suffer, you know, in case the tenant goes away is, you know, the having to recover, you know, the bad debt, having to, you know, find a new tenant. So these are the risks that you have, and these are usually quite short term. I think what we are seeing is that many times, those long leases, when they are not renewed, I think what most of the managers or owners do is to just break it into smaller units, and then some of them actually can fetch even higher rental because they are being unitized in the smaller units, and having, of course, they will suffer a bit from the vacancies and extra work that they have to do. So I think it's I would say asset to asset. It's not necessarily good or bad. So I think we actually have to look at each and every asset and study them well in order to be able to ascribe the right value. Yeah. So that is insofar as the sales and leaseback and structuring is concerned. So I think again, I would say that for every values that you see, whether is it too high, too low, I think if you look behind the assumptions, then you have a better appreciation. That's why I think many a case, the same property, don't be surprised that it can be different by 1-2 times. What you have to look at is the assumptions behind it. And many times, I do a lot of dispute resolution work, and very often I will have to then express the differences in terms of the assumptions, why this value is as such. There's a reason for this value, there's a reason for the other value. So you decide which is the correct one. Sometimes it's not up to us to decide as a valuer.
Okay, thanks. Okay, thank you for that. You mentioned structuring and you also mentioned M&A. So let's come to M&A, and I'm going to ask Natalie about M&A. We've had a lot of restructurings in the last 18 months, and that's been quite exciting for some investors and upsetting for others. Okay, so how do you see M&As? Where do you see M&As going next for the REITs?
Well, I think of course, in 2019, it was a very good year for the REITs. A lot of REITs managed to acquire. Coming into 2020, a lot of REITs also still tried to acquire. I think even despite COVID, there were still some acquisitions that managed to happen. And even though interest rates are rising as we know it, I believe that there are still some pockets of opportunity where some of the REITs can potentially acquire. And I believe that the industrial REITs are actually the players that have been very active in acquisition, repositioning AEIs, and given that their portfolios are sort of still more resilient, I believe, as compared to the headwinds facing the retail as well as the office and the recovery in tourism, I think that industrial REITs are still well positioned to acquire and undertake more of these AEIs. Yeah, I believe it will continue.
Okay, thanks. I have to come to you, Adrian, on this. So how, with this compression that we've seen, especially in places like Australia, how would you make an acquisition accretive?
A lot of people always focus on accretion, immediate accretion. As I said, the real estate is a long-term game. You believe that an asset, in terms of location, in terms of quality of specs, ability to enhance, add value to it in terms of utilize GFA, redevelopment, and increase the usage, and do additional GFA and all. It all takes into consideration when you buy a property. So if you want immediate accretion, no problem. You just do what happened 10 years ago. I would say 10 years ago, when people start to pay over-rented properties, but that is the real bad side of financial engineering. So, as I said, we always look at real estate as a longer term. If you believe that you can value add, that this is a cycle, in a certain cycle, with the interest rate cycle or property cycle, but the properties will still be there, then it's good to actually acquire first, because you're going to have the property, the location. Real estate is about location. You have the property in the right location. Whatever property cycle that you do, you will always be able to survive, and you always be able to stay relevant. And as a landowner, as an owner, you just need to improve the properties and to enhance it to make sure that it remains future ready. So I would say that case by case basis, there are, as the adage goes, right? Things are cheap for a reason. Things are also expensive for a reason. So if you go to countries like Australia or developed countries like Japan, and you see the asset is good, the quality is there, it's going to sustain to you, for the short term DPU, not accretion. On the longer term, your NAV does goes up. Your ability to increase your DPU is able to do that. I think it's still and also diversification, risk as well. That you're able to improve your risk of your portfolio. I do think that as a landlord, as an owner of properties, I think you should really want to do that. Alternatively, you can go and buy a 10-year lease industrial property, giving you 8 to 9%, and immediately you'll be accretive, and then fund it with a low interest cost of 3%. But you know that this is not sustainable. So this is what I personally view as overall, as what people like to call total returns when you look at acquiring an asset.
Okay, yeah, that's just, and of course, in determining the cost, determining the cost to the REIT, the investor is important. Your investors are important.
Yes.
So your investor list should have institutional investors and long-term investors.
Yes, as well as retail investors.
As well as retail investors. So there should be a broad spectrum there. Do you have many institutional investors?
Yes. When we were first, as you know, ESR-REIT used to be called Cambridge Industrial Trust. So when it was as much a smaller REIT, we had more retail investors compared to institutional investors. But as we got bigger, we had more share of institutional investors on our books. And while people and most of the retail investors nowadays have morphed into more, I would say, high net worth as well as family offices, which is another pool. I don't know whether you call it institutional or you call them retail, but we just use it as high net worth and family offices. Which part is which pool is better? I don't think that there is any preference for that. Institutional investors tend to focus more on certain things. They have to have a bit more longer term views, but their key focus is always on size and liquidity because they want to get in and get out. So you want to be in indexes. It's quite important for them, and they can obviously write a bigger check and it's faster. But retail investors tend to have a little bit more, I must say, more patience with holding longer. And in fact, some of the hard questions, if you ask my frank opinion, and relevant and very hard questions, actually come from retail investors, because especially for REITs and for us that have local properties here, they actually understand the local market a bit more. Because they can see and feel the assets. So we are seeing our share of both institutional and retail, but we are, because of our size right now and the liquidity we are leaning, our shareholder register is more towards more institutional.
Okay, that's good. And of course, your ambition is to get into the FTSE EPRA Nareit Index, developed index. Okay, yes. All right.
Yes.
All the best for that one.
Thank you.
Okay, so I need to move to Natalie now. So what are the various factors that determine the market pricing of a REIT? And I think there have been questions about, when are REITs undervalued and when are REITs overvalued? Perhaps you could take that. Yeah.
Sorry, I was on mute.
Yeah, you were on mute. I was going to tell you that.
One of the factors that determine whether a REIT is over or undervalued, I guess, we can always look at several financial ratios. For example, your price to book or price to NAV. Generally, the REITs tend to trade within each sector. They tend to trade within a certain band of price to NAVs. So, for example, you have your retail can go anywhere from 0.8 to even 1.2 times, and then like your industrials tend to trade usually at a premium slightly, and then your hospitality tend to be a little bit under discounted, trading at a discount to NAVs. So apart from that, I think another useful metric that investors can and do look at are the distribution yield spreads. So this is of course relative to the 10-year bond yields, and also in a sense, like presently where the yields are rising and the DPU yields yield spreads have been compressing. So that is when we see some rotational interest from investors where they try to rotate into cyclicals, and that has sort of hurt the REITs a little bit in terms of share prices. So that would be more opportunity cost kind of a way of looking at things.
Okay, thanks. Thank you. Yeah, I need to move to KengChiam for a question that we've had. Okay, we've got a question up on a live question. I've mixed some of them up, but what weight do you place on, I think, your comparables? Because the question here is, when doing valuation, how much weight do you place on the transacted price of a property versus the other methods? You know, you say there's a cap rate, there's a cap, what is it called? The cap rate income approach, and then there is the DCF, and then you have the fourth one, right? You have the what is it? The value based on how much on the cost of building the property. Yeah. Sure. So what are the different weights you place on each of these?
Okay. I think the question is focusing on, let me see.
It's over here. When doing valuation, how much weight do you place on the transacted price? And if transacted price is out of sync with other metrics, how would you value the property?
If it's totally out of sync, we just ignore it.
All right, that's that then.
No, I mean, of course, I think on the surface, we will ignore it. But however, I think we have to look at the other factors. So I think it's not only the pricing, but I think we can also try to decipher and see, what is the cap rate, all right, or what's the rental rate. So what is it that is driving the value up? So I think a lot of analysis got to go into, understanding the deal, or is it that there are certain things, certain scheme of things that actually enhances the value. For instance, there are some cases where the price looks rich, so I think we have to look behind it. So probably it's because premium has been paid. Because I think nowadays, as you know, if you are not the owner, if you buy the asset from, especially if you're a fund, you are required to pay up the premium upfront. Then premium upfront. So that could be included or not. So it depends on how the deal is structured. So there's one of these. It's not that you have to really go in to look at the details. Otherwise, it's very difficult for someone to look at it and say, oh, it's too high, too low. And certain parts of the deal may be relevant, because I think expectation of yield can be there. So I think when you look at the yield, I mean, there are some deals that looks a bit odd, and then if one look deeper, then you can actually appreciate why they are as such, off market. They are not really off market, but because people probably put a premium on the tenants, then you will have to ask yourself, does the market fully appreciate this premium that is being paid? Because it's a blue chip tenant, right? Is it the same for the rest of the properties? If it's not, so if it's a case whereby the tenant is a blue chip tenant and they're paying extraordinary high rentals, then I think we have to ask ourselves, is this tenant going to be there forever or not? So I think all these metrics has to be understood, and we have to make a view, because sometimes these are market data. We have to ask ourselves this question: is this going to be applied to this property that we are valuing? If not, we have ignored them. So that's how I would approach all these transactions. Of course, I think there is this simplistic view and say, oh, look, this property, for instance, like this class of asset is done at $300 per square foot. So the next asset that comes along and people deem them to be the same is 400. And immediately people think that there is a re-rating upwards. Then you have to then professionally ask yourself, what has changed? Is the market that good in order for people to forward price and pay a premium or not? Or is it something within the deal that is causing this difference of $100 per square foot? So I think there's a lot of analysis that has to be done, and not just simply saying that, oh, this is 400, therefore my value should be 400. Then I think we are not doing our work properly.
Maybe if Goola allow me to add a little bit.
Sure. Yes, I was going to say, Adrian. Yes.
Yeah, I view valuation as a guide to pricing of an asset like a property. You ask 10 people will tell you different valuation.
Yes.
It's a guide. It's not the be all and end all. The people who are involved, the stakeholders in buying the asset or selling asset, from the financier to the buyer to the investors, use this as a guide to see how worth it is. But there are a lot of other factors, like KengChiam pointed out. The view of whether the location is there, are there any more supply? Is this a one and only asset? There's no more already. Are there any special specifications? And it is all takes into consideration when a buyer like me actually goes in. And why I say it's a guide, and that is the reason why you have banks who give you the loan, will look at the asset value as a guide and then decide whether what is the loan to value ratio. Is it 70%, 60%, or 40%? And the biggest example to my point of why I believe it is a guide and not a be all and end all is in HDB, right? Valuers give you a price, but the transacted price can be higher. And that's what we call the term cash over valuation. But people still buy because maybe the asset is that this house is near my parents' place. You need the parents to look after your kids. So you want to pay the extra 10% because of that. It's near to the MRT station and all this stuff. So I guess valuation is more a guide, but people like to think that, oh, this is the price. That means it must be able to transact, it can be able to sell. No, people have different views. And also depends on the buyer and seller dynamics. Some buyers are stronger. And because you're stronger, you're in a better bargaining position. You can tell that I'm going to give you financing certainty. I don't need to go and raise funds. I can buy. I still draw down my debt. I go to my ATM and press. You have $2-3 billion sell to you. Whereas some buyers say, oh, I got to subject to funding. And then the seller say, oh, the seller thinks that I have actually more bargaining power. I say, sorry, I wouldn't want to sell at this price. But there are also sellers who are in distress. So valuation is 100. Okay, I will have to sell you 10% discount. So a lot of factors comes into that, and I do think that we should treat valuation as a guide. Now, it's not to diminish KengChiam's professional,
no
skills.
worries. I think
but it's just really a guide. So that's what I'm trying to sort of point out.
No, I fully agree with you, Adrian. I think that there is this misunderstanding about our work. I think what we do is we are just a market observers, and being an independent party, not being influenced by what Adrian is saying, whether you have, specific reasons to buy or several reasons to sell. So I think what we do is, of course, in a rising market, the price keep moving up. But in a market like now we have, there's mixed signal, and there are people underselling, there are people overselling. So I think that's make our life even more interesting, to be able to say, okay, look, this is the fair number. Of course, then you have evidence showing either direction. So I think we must be able to understand, appreciate the market dynamics and the future of the real estate, to be able to give a fair and independent assessment. Fair and independent meaning to say that, where such that, the buyers and sellers are on equal footing, not on unequal footing. So if you look at the definition of market value, then you can appreciate better. There's always this saying, then of course people will say, hey, how then do you, from the observation from the market, then how do you then decipher which is which? But I think the market is actually very more and more transparent nowadays. I think data is everywhere. I think all the buyers actually will know the assets. They have seen all the available properties in the market, and of course they will have their own preference, and they will price the asset according to their liking, but it may not necessarily be the liking of the market. So for instance, like what Adrian's saying, oh, because I want to stay near my parent, this is the only asset that I like out of many assets around there, I don't mind paying a premium. So then you can see that this guy is paying a premium. And then whether the next buyer will do the same, I think it's up to the market forces to detect and determine. So I think our work is, in a way, professional opinion, something that is an art, I would think that it's a mixture of art and science. Yep.
Thanks. And well, we've really overrun our time. So I would have liked to ask one last question, but maybe we don't really have the time. But a couple of housekeeping things. First off, yes, you can, if you wish to receive the presentation slides, you've got to share your feedback on the post-webinar survey after you leave the webinar. And there was a request for replays, and yes, there are replays, but I'm not quite sure how it works. On Facebook there are replays. Okay, all right. What if you don't? What if, like me, you don't have Facebook? Where can I get a replay? YouTube. You can get YouTube. You can get replays on YouTube. Right? Okay. So with that, I guess we've just come to the end of the webinar, and so thank you, Adrian, Natalie, and KengChiam, for sharing your fascinating insights. I know we focused a lot on valuation, but that is really the rock of the REITs. So
thank you very much. Thanks, Goola. Thank you everyone for attending this. Appreciate your time on a Saturday morning. We hope that this session is informative. And for us as a practitioner, I'd like to leave a few words, and that is that we are owners, we are REIT managers. Our job is to make sure that we can find the next value-adding activity, be it acquisitions or redevelopments. At the same time, ensure that the REIT does not take too much risk, and yeah. So thank you very much for your time.
Thanks. Thank you, everybody. Then.
All right.
Thank
bye.
you. Thanks.
Thanks.
Okay, right. Thank you.